Hello my colleagues, in today's video we are going to be discussing indicators. You see, when it comes to investing or trading, be it stock indices, forex or even the crypto market, understanding the dynamics and sentiment of the market is very important. It would help you develop a trading strategy to know the best time and price to enter and exit the market. Very good tool for you as a trader or investor to use to understand the condition of the market is leveraging indicators. I know you'd probably be asking, what are indicators and how can you use it to trade or invest? Well, before I dive into what are indicators and the various types of indicators out there, I would love to give a big shout out to Vantage Market for sponsoring a series on my channel, which this video is actually part of, on indices trading. Vantage Market is an all-in-one trading application if you're looking at trading indices, forex, commodities or even crypto, especially with the current bull run. Vantage Market got you covered. A promo code would be, and the link would actually be in the description and in the comment section for you to download the Vantage Market app. If you use the promo code, you're going to get some discounts, so I encourage you to make your promo code and download the Vantage Market application. And without much talk, let's jump right into today's video. Let's go. So what are indicators? Indicators in trading refer to a mathematical calculation or visual representation derived from price, volume or other market data. These indicators are used by traders to analyze past price movements, identify trends, forecast future price movements, and make informed trading decisions. As I earlier said, indicators can help you as a trader understand the situation of the market, gauge market sentiment, and develop trading strategies. It is also worth knowing that there are many different types of indicators out there, but for this video we will be exploring and focusing more on three of the most popular, known and well used indicators out there. First one is the moving average, the relative strength index, and the moving average convergence divergence (MACD). Starting with MA, moving average. The concept of the moving average dates back to the 18th century when it was used to analyze and predict crop prices, before traders started also adapting the strategy to other markets. To properly explain how the moving average works, I would love to paint a scenario in your mind. Now, I want you to imagine that you are at a bakery and every day you note down the price of your favorite, let's say, meat pie. Maybe you are indecisive and can't decide if the price of the meat pie is going to go up or go down on a day-to-day basis. So you decide to track the average price over the past 5 days. Since it's just 5 days, this is a short-term moving average. It helps you see if the price has been generally increasing or decreasing recently. Now imagine you are a more patient customer and you care more about the overall trend. You decide to track the average price over the past 20 days. This is a long-term moving average. It smooths out the small daily price changes and gives you a clearer picture of the long-term price movement of the meat pie. Now, bringing this down to stock indices, I want you to think of the moving average as a line on a price chart. The line keeps moving because it constantly recalculates the average price based on the chosen time frame. It could be 5 days, 20 days, or even more than that. If the price of your meat pie, or let's say stock indices, is generally increasing, the moving average line will also trend upwards on the chart. This suggests a potential upward trend in the market. If the price is constantly dropping or consistently dropping, the moving average line will slope downwards, indicating a possible downward trend. When it comes to using the moving average indicator, there is what they call a golden cross and a death cross. A golden cross occurs when a short-term moving average crosses above a long-term moving average, signaling a potential uptrend, while a death cross is the opposite. When a short-term moving average goes below a long-term moving average, it's signaling a downtrend, and this helps you know when to enter or exit the market. Now, let me show you a live explanation of a moving average for trading indices using the Vantage Market application. So the first step you want to actually take is to download the app. Use my link and my promo code to to be in the description and comment section like I said earlier, and I'll actually appreciate if you make use of that. Then quickly sign up or sign into the app. So as you can see, I'm actually logged into the Vantage Market application, but this is a live account, so let's switch over to demo. So go to the demo account. Now to set up your moving average on on Vantage Market for stock indices trading, you just scroll over to this place that says indices, you click on it, and let's use the DJ30. I just love the DJ30. Let's use the DJ30. So click on the DJ30, and then we want to select the moving average, but it's actually already on the moving average. But let me say you come to you click on DJ30 and you see this chart, and then it's not yet on moving average. You want to set up your moving average, you just click on this little button, like this little place that says MA, or this little arrow here. Click on it. Oh, just made a mistake. So you click on this little arrow on top here, and then you see the different indicators. You have the Bollinger Band, you have the mic, and then you have the BBI. Well, you want to select the MA, but let me just say it's on the Bollinger Band, and you want to change it to the moving average. You just click on it and click on MA, moving average, and as you can see, it's now on the moving average. We're on the 5-minute moving average, and remember, it tracks the average price for the last 5 minutes. And you can see in the 5 minutes ago, the moving average is actually sloping downwards. It means the market is is bearish, is going downwards, it's trending downwards. And now and you can see, if you want to check for the 1 week moving, you want to check the 1 week moving average, you just scroll on top here, click on 1 week, and then it shows you the moving average for the last 1 week, and you can see it's sloping upward. So it means that this is an upward trend, and probably you want to buy and hold for some time and then sell. So this is basically how to make use of the moving average. Imagine that you are in a tug of war competition between bulls, basically traders who think the market will go up, and bears, traders who think the market will go down. If the bulls are constantly winning the tug of war, it means the price keeps going up, right? The RSI is like a judge who keeps track of how much stronger the bulls are getting compared to the bears. The RSI displays this information as a score between 0 and 100. A high score above 70 suggests that the bulls might be getting exhausted. The market might be overbought. It might be at an overbought region. Conversely, a low score below 30 indicates the bears might be tiring. The market might actually be oversold. Fast forward to 1978, technical analyst Welder published a groundbreaking book titled New Concepts in Technical Trading. In this book, he introduced the Relative Strength Index, a formal way to measure this market strength using a numerical score. The RSI revolutionized technical analysis by providing a clear tool for traders to identify when the market might be overextended in one direction and a potential reversal could be on the horizon. Showing a live example using Vantage Market. So to explain the RSI, I'm logged in already into the Vantage Market application. So we scroll to the place that says Indices, we click on it, and then we go to the one that says SP500, right? Click on it. That's one I want to use this time around. So we click on SP500. Now we want to make use of the RSI, the Relative Strength Index, to understand the market. So what we want to do, we'll not go to this one above that says MA. We'll go to this place that says volume. That's where we'll find the RSI on the Vantage Market application. So we click on it, and then you see here we load the place that says volume. You see here that says RSI. So we click on RSI. So once we click on it, we tap the screen, and then it brings out the RSI, the Relative Strength Index. Like I explained earlier, when it's above 70, it means that the market is at an overbought region and there are high chances that it could go down, right? And then when it's below 30, it's oversold, it might likely go up. So you can see it's already played out here now. You see that the RSI went down to as low as 6.81, and then when it went down, it reversed and started going up, and is now around the 50 region. so it's going up, it's still bullish. So once it touches 70, there are high chances that it's going to go downwards. So that's basically, the RSI helps you understand and know how the market is trending and know when to enter and exit your trade as well. Finally, talking about the moving average convergence and divergence, MACD. It is an indicator used by traders to understand the momentum, trend direction, and potential buy or sell signals in a market. The MACD is a tale of two moving averages, and here's what I mean. Imagine you are a police officer and you need to track two suspects. The name of the first suspect is Emeka Fast, and he's going to represent the short-term price movement in the market. Let's say the daily or hourly fluctuations in the market. Let's use that for example. Then we have Femi Slow. Femi is going to represent the long-term price trend, likely weekly or monthly movement. The MACD uses two moving averages to keep an eye on this suspect. The fast moving average acts like a detective who is very reactive to Emeka's movements, which is the short term. You basically track how the short term price movement is happening in the market. The slow moving average is like a patient detective who is focused more on Femi's long term trends. It basically tracks what's happening on the long term time frame of the market. Now, with this explanation, you might still be asking, so what does the MACD actually do? Well, the MACD isn't a single line, but rather a combination of lines and a histogram. It shows you the relationship between Emeka Fast and Femi Slow, which is the two moving averages, the long term and the short term. It shows you the relationship between the both of them. Now, I want you to remember that MACD stands for moving average, convergence, and divergence. So it is necessary you understand these two terms. So what does it mean to converge? Convergence in moving averages mean when Emeka Fast and Femi Slow moving close together, the line converge. It suggests the market's momentum might be slowing down. Divergence, on the other hand, is when Emeka Fast makes a sharp move, but Femi Slow, still lags behind. The lines diverge. It can be a sign of a potential trend reversal. So if the market was going up, there is high chances that the market would go down, and if the market was going down, there are high chances that it could reverse and start going up. I hope that makes sense. The histogram also visually highlights this convergence and divergence. As usual, let me explain using the Vantage Market application. To explain the MACD, I'm logged in into Vantage, which is what I've been using to explain all the indicators. You click on this place that says Indices, and then let's make use of the DJ30 to explain the MACD. So we click on DJ30, it brings out the charts, and then for us to make use of the MACD, we go to this place that says this down part of the chart that says RSI, that shows the RSI. You click on it, and then you see this place that says sub indicators. That's where you find the MACD. So you click on you click on the MACD, and then it brings out the MACD. And now if you can see, this blue line on the MACD is for short term. It tracks the short term price movement, and then this yellow line tracks the long term. It's a slow one. It tracks the long term price movement. So you can see that when two of them are apart, the market is showing green, like I explained earlier. And then when two of them go down here, you can see the histogram is actually these bars you're seeing here. These bars, it tries to help you understand these two lines. So when it's going up and then they're a little bit apart, the market is green. And then when they almost touch and when they are down, it means that the market is bearish, if that makes sense. So let me see if I can explain. Let me just scroll a little bit further. So you can see that they touched here again, they touched here around this side again, and the market is red, and then there's a little bit difference there, and then it goes up a little bit and goes down. And then anytime it goes upwards, the market is usually bullish, right? And then anytime it goes down, it slopes downwards, the market is bearish, right? I hope that makes sense. And you can see that convergence that I explained earlier, when they are trending together, when they come together, you can see that it's as if the market was slowing down, and then boom, it reversed and went downwards, right? And then divergence, they are trading apart, and then the momentum was a little bit higher, and later on there are high chances that the market could still go down, reverse. Let me see if I'll find another one. Okay, for example, here again. Okay, let me scroll. Let me find. Okay, you can see here that the market was bearish here. Emeka Slow was far from Emeka Fast. Sorry, Femi Slow was far from Emeka Fast. Emeka Fast is the blue one, Femi Slow is the yellow one. And then you see that the market reversed. It was trending downwards, and then it was too far, and then it was trending downwards, and then it reversed and went up, right? So that is just divergence. It's just the divergence I talked about earlier on. So that's basically the MACD indicator. Overall, guys, it is important to know that these indicators are just tools and not some magic formula or wand. They should be used with other forms of analysis like fundamental analysis for a well-rounded trading decision. If you enjoyed this video, I have another one where I break down indices trading properly, and I encourage you to go watch that video as well. And do not forget to check out the Vantage Market application. Do well to also smash the like button, subscribe to the YouTube channel, and see you on the next one.
No one is born a trader. Be reborn a trader. Trade smarter at Vantage.